Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
So you were saying you were in New York recently for a conference?
Yeah. So it's good, but it's good to see people that we hadn't seen in over 2 years. It's crazy to think about how much. I went from no drivers in my household to a kid in college. I'm like, what happened? So yeah,
life happened. Life changed, right? And
yeah, exactly.
Welcome to another episode of Trends with Benefits. Today, my guest is Ed Clissold, Chief U.S. Strategist at Ned Davis Research, and we're going to be talking about U.S. markets. Hey, Ed, thanks for joining.
Yeah, great to be here. Thanks for having me.
Absolutely. You know what they say about two Eds, right?
No, what? I'm afraid to ask.
Better than one.
Okay. I thought that maybe was like an Ed Koch joke or a joke about a horse or something.
No.
Okay.
I don't know if anybody ever says two Eds are better than one, but why not? I think this is going to be a great show.
Yeah, no, that's good. Yeah, I'm sure, like you, I'm used to the Ed jokes all my life. So yeah. I was an Eddie spaghetti because I was so skinny. It's no longer an issue.
Oh, really?
Yeah.
I never got that one. Actually, I think I'm going back to Eddie for select friends. Old friends will call you that still, probably.
Yes, actually. Yeah, you see somebody I haven't seen in decades, and then your new acquaintances are like, who is this?
Yeah. So how long have you been in NDR these days?
20 years. Yeah, just past the 20-year mark, which, in this industry is amazing, but we have people who have been there for 30, 35 years. And
wow.
Of course, Ned's been there since he founded the firm in 1980. It's one of those places where if you make it the first couple years, you usually are a lifer.
Yeah. I mean, there's a number of long-termers, I guess, if you will, at Van Eck also. I'm going on 13 years there. So did you start after school at NDR? Did you have other stops in the finance world?
Yeah, so actually my first job was as a client of NDR, and my boss, his name is Bruce Biddles, was and still is a very good friend of Ned. So I used the work, and then the firm I worked for, J.C. Bradford, was a regional brokerage firm. We were bought out. Ned had actually worked there before. He had started NDR, and so that was my connection to the company. So I was thrilled, when the company gets bought out, what am I going to do with my life? And I was able to latch on to NDR from there. I've spent a few years thinking, this is a really cool place. It'd be great if I could work there one day. And
lo and behold, you manifested that.
Yeah.
Tell me a little bit about your day. What keeps you busy?
Yeah, so NDR for us, it's really about data. We have over 10 million data files in our system, and data is probably easier to get than ever. You can go online, get it for free, download it from wherever, grab something off Twitter. But clean data is probably harder to get than ever. And we have a team of people who do nothing but scrub data, which is fantastic for someone like me because I can come in like a kid in the candy shop every day and start working with the data. We have our own software system that we use to analyze the data. So if you see an NDR chart, there's a very unique look and feel to it. And that's by design. We want people to know it's an NDR chart. And there's a whole statistical package behind the data. So if we want to put a chart on our website, show it in a research report, it's going to have gone through a very rigorous process. So that's the kind of nitty gritty day-to-day stuff that we're doing. We're looking at data, trying to find data that can be predictive for the financial markets, be it absolute equities or relative to another asset class or sub-asset class. And then we combine the data together to create models, and we put the data into 4 different buckets. So there's fundamentals, there's earnings, valuations, macroeconomics, so what's going on with the economy, interest rates, the Fed. And that tells you how the market should act. And over the long run, it does. But as Keynes was famous for saying, the market can remain irrational longer than you can remain solvent. So we're also going to look at investor sentiment and technical data, or the price action of the market. And that tells you how the market is acting. And so we combine those 4 things together. So I think what people like about NDR is when they ask us a question, say, what does NDR think of X? We're going to answer it through that prism of the 4 different types of data. And through a very objective, quantitative way. We're crunching the numbers daily and then trying to write research reports for our clients that are easy to digest because most of our clients are not macro technical analysts, quant geeks like us. So they want to come in, read the stuff quickly, and then move on to the rest of their day, be it picking individual stocks or if they're economists, whatever they might be. So it's about, taking some sometimes complex information and digesting it as easily as possible.
Yeah, you guys have a lot of great data, a lot of great charts. And the models, are the models portfolio models of U.S. equities and sectors, or what type of models are they?
So, well, we have a lot of them. Probably our most popular are, our asset allocation models. So looking at stocks, bonds, cash, and also commodities. But then we drill down into sectors. We have a model that calls the 11 S&P 500 sectors that probably a lot of people are familiar with: technology, financials, et cetera. Then the old style boxes: small versus large, growth versus value, and then regionals and fixed income. So pretty much any of the big things that you may think of, we've got a model for that.
So one of the reasons why I wanted to have you on, and thanks again for being on the show, is I feel like there's a lot of things happening in the markets today, in the U.S. markets today. A lot of different cross currents, whether it's inflation, recession talk. Also, there's global politics that affects us as well. I don't know, just quickly, is there, in your knowledge, is there another time that's analogous to this time that we're going through?
Well, first of all, this is pretty rare because we have a lot of macro fundamental indicators that are screaming negative signs telling us to look out. At the same time, the investor sentiment is so pessimistic and the technicals have been improving. They're saying, hey, this could be a new bull market. So that is very, very rare. But when it tends to happen, it actually tends to happen as the market is rebounding because, look, an earnings report is backwards looking. The economic data is what has happened to the economy, and the markets tend to be forward looking. So if anything, it's probably saying that things could be getting better. So you see these a lot of times at key junctures when you're going from a bear market to a bull market.
And, I've seen a lot of talk recently about September. Obviously, after Labor Day, markets, people are back. And then the market history about September, I think one of the worst months historically, or perhaps the worst month historically. How much weight do you give to those narratives, and how much weight should investors really consider in terms of thinking about investing again in the market in September?
Yeah. So if you go back to the 20s, September is the only month that for the S&P 500 has lost on average. So it is the weakest month of the year. Let's look at the whys. This is this just some random act where you flipped tails more than heads more often? I think there is something to it. You get back from Labor Day, and the deal flow usually trickles in the summer, and the investment bankers come back from the Hamptons, and so you get more supply of stocks and more secondary offerings, more initial public offerings. That may not be happening this year. So that additional supply of stock may not really be there. On the other side of things, you tend to get a lot of earnings revisions in September. So we all know the drill. If you follow a company's earnings, they start off the year very optimistically, and then they say, well, Q1, maybe let's take those numbers down, but we're gonna hit them in Q3, Q4, the end of the year. But by the time you get to September, companies go through pre-announcement season where they're saying, okay, we're not going to hit our Q3 numbers, but reality sets in, they're probably not going to hit their Q4 numbers. So that's a big reason for September weakness. It's the earnings estimates are kind of a throw in the towel type of period. That is definitely in play this year. If you look at how much Q1 and Q2 earnings were brought down, there's still some room for Q3 and Q4 to come down some more. So I think there's some reason for concern about September. But maybe not everything lined up. But yeah, there actually is some justification for it. It's not just a random act where you're going to find one month that obviously has to be the lowest of the 12. There's somebody has to be last, but it actually makes sense here.
And what's your take on the probabilities for a recession?
So as we move into next year, those probabilities increase. The risk right now are pretty low because the labor market is strong. The U.S. economy is about 2/3 consumer spending. So if you're adding several 100,000 jobs a month, it's pretty hard to get economic contraction. But that could slow down next year as the economy feels the weight of all of these Fed rate hikes that are going on right now. So we're getting some information on that with our economic timing models, which take into account a whole lot of different data series, are showing a lot more warning signs, and then also the yield curve inversions that we've seen, that is long-term interest rates below short-term interest rates. We've seen that not just amongst the widely followed like 10-year versus 2-year, which has inverted, but you've seen that more and more along the curve with corporate rates, with treasury yields as well, and that's more of a warning sign. It's just not necessarily it's an immediate issue. Again, it's more of a 2023 issue.
Yeah, so it's interesting. You talk about 2023 and recent surveys that have come out talking about investors are fleeing equities for fear of a recession. Are they doing that too early?
Well, that's part of a thesis for a year-end rally is that they've gotten a little bit ahead of themselves. So the market, the stock market, S&P 500, has peaked on average about 5 months before the start of a recession. So if you look at the peak back in January, that would mean that, again, just using the averages, which, averages are averages, there's some shorter or longer, but, that would mean that the recession probably started in June, which most economists don't think happened. Now, there were some cases where there were big peaks, like long lead times between the bear market start and the recession start. And usually you got really big rallies in between. So for example, in 2000, the market peaked in Q1, the Dow peaked in January, the S&P peaked in March. The economy didn't fall into recession until March of 2001, so a year or so later. And you got a massive rally in the fall of 2000. I don't think a lot of people remember this, but the S&P 500 Total Return Index hit a new high in September of 2000. The price only one didn't. Of course, the NASDAQ was well below by that point. But that kind of big rally, as investors weigh recession, no recession, is kind of how the sentiment plays into the macro. Whereas if you just kind of fall into recession sooner, well, there's no time for this will it or won't it type of action to take place. It's just we're going into recession. So that's part of maybe a year-end rally case, is that maybe there's a moment or two where perhaps the soft landing gains some traction and the market can rally, but then the market starts to anticipate the reality, which is that the Fed has a very poor track record of achieving soft landings. And so probably, the recession will come sooner rather than later. But you're right that a lot of people have already positioned their portfolios accordingly.
In terms of that year-end rally, do you see that coming or being a broad-based rally across various sectors, or do you see any particular sectors leading the charge?
So one area we actually like, if you want to position for a year-end rally, would be small caps, because number one, they tend to be higher beta. Secondly, they have already been through a brutal bear market. The Russell 2000 index of small cap stocks has fallen about 32%. So much more than large cap stocks. And relative to large caps, actually peaked in March of 2001. And you saw signs, for example, in June, small caps held up better than large caps. And that's kind of a sign that maybe the leadership is shifting. But then fundamentally, small caps are cheap. Usually investors pay more to own small caps because they're growing faster. So you pay a higher PE ratio to get the growth. Right now, small caps are trading at one of the biggest discounts. That is, they have a lower PE ratio than large caps that we've seen since the dot-com bust. The issue for much of last year is small cap earnings growth was less than large cap earnings growth. So you're not getting earnings growth to justify the lower valuation. But now earnings growth is basically in line, large and small, and they're cheaper. So there's a little bit of a fundamental justification on top of the deep technical oversold possibility here. So that's probably our favorite area to look at when it comes to how to play the year-end rally.
That's interesting. So in the small cap space, I mean, they haven't worked for quite a few years, right? They've lagged large caps for a while. Why do you think that was?
Yeah. So first of all, to be clear, this is we might call it a tactical call, right? So this isn't necessarily, we're not necessarily making a strategic call on how you position your portfolio. But you're absolutely right. Small caps have underperformed for 11 years. And if you think back to the Fama-French equation, which is, there's three factors to focus on: market beta, book to price, and then market cap. That is, Thomas French told us, buy small cap stocks, you should outperform over the long run. And for decades and decades, that was largely true. But for the past 11 years, it hasn't been. And so what I've noticed is that even in the last, say, 3 or 4 years, I haven't gotten questions about it. I used to get lots of questions. Should I buy small cap? Should I not? And I think, 11 years will do that to someone. They feel pretty beaten up and not that interested. So I think if you want to think about long-term issues where maybe there's an unloved place to market, small caps is one of them. But I think another issue is that U.S. large caps, just dominated the economy. You think about these fan mag stocks, these large tech stocks that were just performing so well from a business standpoint. Why would I want to mess with a small cap stock? And so there's some other things too with the market where companies stay private for longer. So sometimes you don't get the growth that you got before by owning a small cap stock. They stay private, and then when they go public, well, you kind of miss that really sweet spot of growth. So some things maybe are permanent, other things are more cyclical.
Yeah, that's interesting. I was also wondering about market structure and the way that people invest today and index funds and their 401k, whether that had become had gained so much momentum that it just more and more money was just automatically fueled to market cap weighted large cap stocks.
I think there's probably something to that. It's a really good point, Ed. Yeah, where people just put their money into their accounts. They do it every month, every paycheck. And I think there's been studies to show that most people never change their allocations. When they join the company, they put it in, and then they don't think about it. And so it does become a self-fulfilling prophecy. And then when you think about what you did 25, 30, 40 years ago, if you got bullish, you called your broker and maybe he or she had a handful of stocks they'd recommend. Now you can just get on your smartphone and buy 500 stocks with a click, and maybe even get like some balloons or something like that coming across your screen if it was a good trade. It's just so different now than it was then, and that probably does play a role. But it doesn't mean that small caps can't have a tactical run. And then even over the past 11 years, they have had periods of several months to a few quarters where they've had some really good moves.
Do you guys happen to look at sectors or themes in any way?
Yeah, so we have a model looking at sectors, and right now it's kind of in transition. So last year it really picked up on the energy, materials, industrials, called cyclical value theme, and rode that for a while. Then earlier this year it got very defensive as the market was pulling back. So then you're talking about utilities, consumer staples, real estate, healthcare. Those sectors tend to have higher dividend yields, more protective during a down market. And it's been transitioning out of that, but it is not a major call right now. We are overweight consumer discretionary, which may surprise people a little bit, but actually during a period of economic slowdown, consumer spending is more stable than CapEx usually. So that's what the model is picking up on. It's negative on materials as part of the decline in commodity prices, but also negative on financials as well. The inverted yield curve tends to be bad for financials because they make their money mostly on the spread, or you take a deposit in at a short-term interest rate and then you lend out at a long-term interest rate. So a negative or inverted yield curve makes it that much harder for financials to make money. So that's kind of where our sector model is at the moment.
And the perspective or the time frame of your model, what is that? Is that over a 6-month period, 1-month period, kind of?
Yeah, good question. It's usually about 6 months is the objective, but we build our models to be flexible. That is, if something's really working for a long time, we're going to stay on that trade. Could be for years. If a period of market volatility, like I described what's gone on the last 9 months or so, the model is going to be a little bit more tactical and move more quickly. And that's where having the technical indicators in the models really help. They're going to pick up on that big move. Whereas if you're just looking at, say, hey, what's the economic backdrop, you could miss some of these things that are going on, and you have massive drawdowns where maybe you had a great run for several years and you give up most of it, waiting for the macro data to confirm that trade is over. And so that's where the technicals can speed up or slow down as the market dictates.
So a lot of analysis, a lot of data that you guys look at and that you look at as well. How about you, Ed? Let's say you are on vacation for 2 weeks, no phone, no connection to anything, off the grid. You come back. What's the first thing you look at? How do you get started to get reacquainted with everything that's going on?
Yeah, so I'm a total chart geek. So I have several chart packets that I go through, and so I would start off with our technical indicator chart packs. If I have 100 or so charts I go through, but then hit the other, look at earnings, look at whatever economic data has come out, and same things the investor sentiment, and you just start going through, seeing what jumps out in the charts, and then you go from there. Say, well, hey, what happened with the latest jobs report? That seemed different from the trend over the last 6 months. I have to go back and see what happens there. So, but that's the beauty of doing quantitative analysis, is you can get a lot of information pretty quickly, and then you do your homework on and trying to dig into the details and go beyond the charts.
So you start with the technicals, not even the broad macro picture. You start with the technicals, see how things are, what jumps out at you, and then you try to explain it with everything else.
Yeah, it's interesting because people sometimes think technicals are voodoo, and if that's your opinion, that's fine. You do you, but I think of it as a running conversation between investors and what's going on in the world. And if you can see, okay, the market reacted like this, and then go back and say, well, what happened? Well, so sometimes you may get like a really bad economic report, like where it shows, well, the Fed is going to have to raise interest rates even faster than we thought because of this report. And then that was a reversal day. That is, the market opened down and then it reversed and closed higher. That's pretty interesting. That maybe the selling is exhausted. Maybe that everybody who was going to position negatively already has, and there's not a whole lot of selling left. As an example. Whereas if you start the other way and go, oh, well, that CPI report was terrible, then maybe you kind of create your own narrative in your mind, and you miss what the market's trying to tell you.
All right. So Ed, let's say you could only look at 3 charts for your intelligence for the next 6 months to a year. What are those top charts for you? Which ones do you want to carry with you?
Yeah, so I think that the first one would be our crowd sentiment poll. And so it's not our poll. We're not polling people. We're using the polls from other data sources. As we talked about earlier, individual institutional investors, market drive gauges like the VIX. That would tell me where investors are positioned. So that would be the first one. The second one is our Big Mo tape composite, which is a percentage of sub-industries in uptrend. So it's a long-term trend indicator and breadth indicator that would tell me, are most industries participating in the market? Are they trending up? The other one would be looking at earnings momentum. And one of the things we found by doing all the research in the markets is it's not necessarily the rate of change in data, it's the change in the change. Is it accelerating or decelerating? And so earnings acceleration, deceleration is a really good way to think about how the earnings cycle is impacting the market. And so that would be another one that I would look at. Of course, that's not only going to update once a month, but if you're looking out 6 to 12 months, it's a pretty good indication of what the fundamental underpinning the market could be.
And typically, what's the best way for people to access those charts? Through the NDR site? And they also come with very specific codes, right? Those particular charts?
Yeah, so we have over 20,000 charts on our website. So ndr.com is the website. Of course, it's password protected, but each chart does have a code. You can search by title. We have a group of very loyal NDR fans, and we say, hey, if we can get people to use our service for 3 years or use it for their entire career, and they learn the chart codes that go with them. So S574A, Davis 250, and S685B for any our NDR clients out there. They can search for those 3.
So other than like looking through all your charts and data packs, do you consume external research? Who do you like to read or follow?
Yeah, so I've worked hard on my Twitter feed to try to get out the trolls and the perma bulls and perma bears, which is not easy. There are some very wonderful, smart people who share some good information on Twitter. Helene Meisner is fantastic. Walter Deemer, Ryan Dietrich are a few people that jump out to me that just provide good information. Try not to get overly bullish or bearish. They just say, hey, here's the information, and just some other friends of the business along the way. Willie Delwich does great work. Jim Stack at Investec as well. And then I try to actually spend a lot of my reading not necessarily on technicals. I've been reading Peter Zion's recent book on the end of the world. Is just the beginning, which is interesting food for thought. I'm not sure I agree with all of it, but certainly it's a way to think about the world. So you try to get outside my area of expertise and learn about how other people are viewing the world.
And since our podcast is about trends, what's one long-term trend you see playing out over the next year or several years?
Yeah, so the rotation from growth stocks to value stocks, I think, has a few more years to go. We could get a counter trend rally later this year if the market picks up. I would think growth stocks probably do pretty well during that. But if you look at what happened from 2000 2006, which was the last time that value stocks outperformed growth stocks, there were three big drivers. I think two of them, in slightly different ways, are in place. So first of all, the dot-com bubble burst in 2000, where the big growth stocks got hit. This is not dot-com 2.0. These mega-cap growth companies make money. But it's closer to, say, the Nifty 50 in the early 70s, where these companies were good companies, but they just got over-owned by everybody. And so there's going to be a period when maybe there's an reallocation, which is going to take time in a period of algorithmic trading and money going in ETFs. But that could take a while to unfold. Secondly, you had a period of globalization of China coming into the world economy and the massive resource demand that went with that back in the 2000s. Now we're getting a reversal of that deglobalization, where supply chains are becoming regional, and there's a manufacturing renaissance going on in the U.S. I would say it's more North America, not just U.S. And so, but that is going to put a demand on resources even beyond things that are going on in Ukraine and the like. That's going to be around a while, and that's going to favor value stocks like industrials, energy, material stocks. The third one was that financials did very well. We had a housing bubble, which helped financials for a few years in the mid 2000s. We haven't seen that yet. We haven't seen that financials can take the mantle of leadership. So I think that's going to be the big question, whether or not this value rotation lasts 2-3 years, or can it last 5, 6, 7, 10 years? Financials eventually going to have to step up.
So you actually answered one of my trend or fad questions, which was going to be value stocks. So we've got that one out of the way. But the speed round, trend or fad, I'm going to ask you about 3 or 5 different concepts, and I'll get your quick take on that. Trend or fad?
Sounds great.
Cryptocurrency, trend or fad?
Fad.
Alternative investments, trend or fad?
Trend. Electric
vehicles, trend or fad?
Fad for now. Eventually it'll work out.
And sabbaticals, trend or fad?
Fad, as much as I would love it, but I think the U.S. economy is too dynamic to think that everybody's going to be able to just take months off at a time. That's the sign of a tight labor market, my friend.
Yeah. I'm sorry to hear you say that.
You know what might be nice though is if, and I'm as guilty as anyone of not using vacation, of just feeling like I have to. It's okay to take a break. It's probably good for you. So maybe that's the result of it. We're not taking sabbaticals, but we're actually recharging ourselves and getting away from our jobs and unchaining ourselves from our desks.
Ed, thank you very much for your time today. What's the best way for people to follow you, find you, and know what you're up to? Career-wise. Yeah. Well, the rest it's not very interesting. I'm going to tell you, a father of 3 living in suburbia. I mean, good luck with that. But at Ed Clissold, EDCLISSOLD is the Twitter handle, and www.ndr.com is our website. Wonderful. Thanks, Ed. Appreciate your time.
Oh, thank you. Had a blast.
And thank you for tuning in to another episode of Trends with Benefits.